Okay, let's dive right into this massive shift happening in the AI boom today, because it's no longer just a story about stock prices and GPUs. Welcome to today's Explainer, where we're digging deep into the Day 56 Topic A cognitive capital analysis. For a long time, the artificial intelligence narrative has been totally dominated by one thing: who's got the fastest chips and the smartest models. But the landscape is fundamentally shifting. The AI infrastructure buildout is becoming so massive that it's actually evolving from a pure product and chip story into a hardcore capital market story. Now, before we really get into the weeds, I want to clearly state that this explainer is strictly for education and analysis. It is absolutely not financial advice. We're just here to look at the data, understand the market mechanics, and figure out exactly why the next major signal for the AI industry isn't about silicon anymore, it's about credit.
Just wrap your head around this staggering number, $20 billion. That's billion with a B. Back in June 2026, MarketWatch and Axios reported a massive development that honestly caught a lot of people totally off guard. Nvidia launched a historic $20 billion multi-tranche corporate bond deal. Nvidia, one of the most profitable, highly valued companies on the planet, is joining what's become a massive industry-wide AI borrowing spree. When a company at the very center of the AI revolution starts tapping into the bond market for tens of billions of dollars, well, it kind of forces us to completely rethink how this global build-out is actually being funded.
So this brings up a really obvious question. One our skeptical analysts are definitely asking. If these AI giants are swimming in cash from unprecedented demand, why on earth are they suddenly borrowing tens of billions of dollars? And it's a totally fair question, right? We constantly hear about the massive revenues these tech titans are pulling in. So why turn to Wall Street for loans? Why take on the heavy burden of interest payments? Well, to answer that, we have to look past the software and the hype and look at the actual, physical reality of what it takes to build artificial intelligence at a global scale today.
Here is how we're going to break down this major shift. First, we'll look at 1. The new AI scoreboard. Then, 2. Inside the capex flywheel. After that, 3. Who wins with cheap capital, followed by 4. The hidden timing risk. And finally, 5. Your AI market watch list. Let's get into it. Starting off with Section 1. The new AI scoreboard.
The old scoreboard was pretty much entirely focused on tech specs and stock prices. We've been completely dialed in on GPU demand, model quality, and soaring valuations. That was the stock story. But the sheer physical scale of what's required to make AI work now, the land, the cooling systems, these absolutely massive data centers, means the scoreboard has essentially been rewritten. CNBC reported back on June 20th, 2026, that tech investors must now watch the bond story. That means tracking debt financing, power interconnection, and serious construction lags. The focus is dramatically shifting from who has the best AI model to who can actually finance the real-world data centers long enough to win.
Moving right along to Section 2, inside the capex flywheel.
To understand exactly why debt is suddenly so crucial, we've got to look at the mechanics of building AI at an industrial scale. It's incredibly capital-intensive, and it operates on a very unforgiving timeline. The sequence goes like this. Step 1, borrow capital. Step 2, buy chips. Step 3, build data centers. Step 4, connect power. And only then, way down at Step 5, do you finally generate revenue. The AI infrastructure build is entirely front-loaded. You have to lay out billions of dollars years before a single customer runs a query that actually pays you back. It's literally like building an entire factory before you even have the electricity to turn on the lights.
Which leads us to this absolutely vital concept. Debt preserves flexibility while spending precedes revenue. Even companies that are completely flush with cash use debt. Why? To keep building at a breakneck pace while preserving their cash reserves for other strategic moves. They're making a massive bet, basically assuming future AI revenue will eventually justify today's astronomical construction bill. It's a completely rational move when borrowing costs are manageable, but make no mistake, it entirely changes the risk profile of the whole AI race.
Which brings us to Section 3, who wins with cheap capital. When the game shifts from just writing clever code to raising billions of dollars in debt, the rules of who can win and who gets pushed out change overnight. If credit stays open and flowing, the ultimate winners of this new credit mode are the massive incumbent cloud platforms, key chip suppliers like Nvidia, and major infrastructure partners. They have the scale, the trusted cash flows, and the ability to secure low-cost financing. On the flip side, smaller startups are getting severely squeezed. Even if a startup has a fantastic product, they simply cannot finance a global data center footprint on their own. This reality pushes them directly toward acquisitions or deep partnerships with the giant cloud providers.
I really love this quote because it perfectly captures the new era we're in. The moat becomes less about one clever demo and more about the ability to deploy compute at industrial scale. The AI race is no longer just some software competition hatched in a garage. It's an industrial-scale deployment battle. It's honestly reminiscent of building the railroads or the electrical grid, where access to cheap capital is quite literally your biggest weapon.
Now for Section 4, the hidden timing risk.
But what happens if the AI demand is totally real, but the financial payback arrives much lower than expected? This is exactly where the debt cycle can suddenly turn from a powerful growth engine into a pretty precarious trap. There's this dangerous, capital-draining gap between the bond issuance happening right now and the revenue ramp way down the line. In between, you have a massive construction lag and potential power connection delays. There's a gap between when interest is due on these massive bonds and when the data centers finally start making money. And look, the debt exists right now. Interest expense is not patient. It really doesn't care if your data center is stuck waiting on a local permit.
And power is fast becoming the ultimate bottleneck. In June 2026, FERC, that's the Federal Energy Regulatory Commission, launched aggressive targeted actions to speed up power grid integration for large loads like data centers. And the reason is simple. An expensive, state-of-the-art AI data center without electricity is just a very, very expensive concrete box. The infrastructure is totally meaningless if it can't be plugged in, which highlights just how incredibly tight the timing risk is for these debt-funded projects.
Now, to remain strictly neutral here, we really have to weigh both sides of the coin. The bull case remains incredibly strong. Broad enterprise adoption is early, cloud providers have massive scale, and the margins look robust. But we absolutely cannot ignore the stress case. What if power scarcity delays revenue? What if the cost of AI models falls faster than the infrastructure can pay for itself? Or what if credit spreads widen and borrowing just becomes way too expensive? It's a very delicate balancing act.
And finally, Section 5, your AI market watch list.
So, what should operators actually be looking for on Monday morning? Again, without giving any financial advice, here's a practical framework based on the cognitive capital analysis to understand where the AI infrastructure story might strengthen or where it might crack. We've got a watch list breaking down 4 critical metrics. First up, debt. Track the bond issuance from infrastructure companies. Are they still borrowing easily? Second, power. Keep an eye on FERC approvals and grid connections. Third, utilization. Are customers actually using this newly built compute at scale? And finally, revenue. Verify that cloud margins are holding up enough to actually absorb these massive build-out costs.
Monitoring those 4 elements tells you exactly when the narrative shifts. We're moving away from that hype-driven growth at any cost phase and entering a strict requirement to prove the economics. The debt market demands returns, folks, and as these multi-billion-dollar bonds mature, the companies that borrowed the money will have to prove that their infrastructure can actually foot the bill.
So as we wrap up this explainer, we're left at a pretty fascinating crossroads. Does the ability to finance, power, and fill this infrastructure create an untouchable, durable moat for the tech giants? Or are we witnessing the start of a precarious debt cycle that's going to require absolutely perfect execution to avoid a massive crunch? Keep an eye on those bond markets because they might just hold the answer. Thanks so much for joining us, and as always, keep learning.